My name is Michelle Kile. I definitely envision that branches will continue to go through transformation. Specifically, they're going to change how they interact with customers and members today. So they'll switch from what used to be very transactional to an educational center or relationship building. So typically your transactional centers or transactional in setup, they may have a teller line. They'll have defined employee roles. You'll have access to specialists as you need them via appointment. They have designated lobby areas, teller areas, designated offices, large lobbies, fixed marketing materials. You'll have access to ATMs and drive-ups. That's kind of what we have today. But we do have some financial institutions that have started towards the educational centers. So those, when you walk into an educational center, have a consultative setup. They're very warm, they're welcoming. The roles of the employees are sales and service. So they're going to toggle between multiple areas. You may have virtual access to specialists where you can have a mortgage appointment, financial or wealth appointment right there on site. They'll have collaboration areas. So there may be shared conference rooms where from the community, you can go and book the room and you can interact with others. They'll have ITMs, tellers, teller pods, ATM access. So you're going to find various technologies as well. And as we talked about, interactive digital kiosks, displays, video conferencing areas, and modular transformative designs of the branch. So no longer just stuck brick and mortar. And what's interesting about that is we talk about customer or member preferences. According to an MX study of what drives or influences where customers choose to bank, 53% saw financial institutions as just a place to have your money. 55% saw financial institutions as a partner in helping them reach their financial goals. So when you think of the two, think of the first one is that transactional center. Some have already started to shift. That's that educational center. According to a JD Power study this year regarding customer satisfaction, one of the things that was found is there was actually a gap in between customers that interacted digital only and branch only, and ones that did both. And what was found is that digital only, while again may be convenient, was the scores lacked in empathy and in problem resolution. So based on the data and based on just general observations, people do want to know, specifically when they have a problem, when they have a more complex transaction, that they can go in and interact with someone versus potentially being on hold, transferring from area to area, or dealing with someone virtually. So I always do think that specifically for those types of transactions, people want to deal with people. If financial institutions haven't already defined criteria for what success looks like or profitability looks like across their branch footprint, they should definitely look into that. You can look at deposit base, you can look at that service level, look at the market share, look at the opportunity of the market, the transaction volume from a lobby standpoint, from a teller line standpoint, look at the lending base, the amount of headcount or FTE that you currently have today, look at the expenses, the product penetration, the product profitability that are aligned with each of your branches, and how on a year-over-year basis that's changing. What do their new accounts look like, their new relationships or memberships, their new products and services? So that will tell you quite a bit. And what you can do from there is group your branches into categories. And what that's really helpful for is it's not supposed to be a bad thing whether you're a branch 1, 2, or 3. It just defines the opportunity and the size of your branch network. And what it can do is, when shared with marketing, for example, determine really where you want to spend your dollars. Where will you get the biggest opportunity to market to a larger group of people? So that's really helpful. We also utilize it when we're going to pilot a new product or service. I've seen that used as well. So based on the area that you're in. Regardless of the type of technology, the fact that it has to be seamless and integrated for the member or the customer is what's most important. You don't want to have these disjointed customer journeys where they start in one avenue and they may go to another, but there's friction. It has to be frictionless. I think that really equates to the banks that figure this particular thing out. The larger the market share, the larger the opportunity. Because what we do hear from our customers and members today is that they value their time and the ease of being able to do business as they want to do business. So if they want to start an application in a branch, go home, think about it, and then pick it up online. That whole transaction should be seamless for them. It shouldn't have to be, I've started in the branches, now I have to start all over again from the other standpoint. So I think that's really, really important. And again, keeping in mind that the customer is in the driver's seat. They are really who we're designing and looking at these technologies for, and being very thoughtful in how they want to interact. And the last piece that I'll say as well is the more seamless that we're able to allow our members to transact, or customers to transact, the better also that equates to the employee experience. So hopefully, if you're using the right technologies, the employee experience is simplified. They're not going through multiple systems or multiple clicks to get information or to help the member, which again allows them to have more educational, consultative approaches and conversations with their members. I think that's what I love most about the banking industry is there's always things changing and new things coming onto the horizon. I would say a few things that come to mind for me: open banking, the continuation of the expansion of really our competitors. Before it used to be true brick and mortar branches, but now we've seen the rise of neobanks and fintechs, which again have really changed customer preferences. And it's something that we have to pay attention to. And we've even have non-traditional banks, if you will, looking into the banking sector and space. So again, knowing that our competition not is solely financial based anymore is very interesting. There's also the great wealth shift that is upon us. So as our older generations pass on and transfer that wealth to the younger generations, specifically Gen Z and millennial, that's a huge opportunity for a lot of financial institutions and something that should be top of mind. AI is another piece as well that should be top of mind. And my advice to financial institutions would be a few things: plan, research, prepare internally, have those discussions, look at the pros and cons from all sides, not just what the data and metrics are telling you, but what are your members or employees saying? Try it, pilot it. What do you have to lose, right? And then embrace it. I think that's the best thing that we can do with some of these new technologies. We may be fearful, but if we can embrace it, the better it is. Think of our frontline employees who are going to be utilizing it or encouraging our members and customers to utilize it. We want them to have faith in the products, services that we utilize. What better way? So involve your employees as best you can, as early as you can in the decisions you're making, why you're making them. Let them test it themselves. At one of the financial institutions I worked at, I loved that they always encouraged their employees to be the first ones to try new products and services, which was great. It helped them have those better, robust conversations with their members and customers.